Hi, good afternoon, and welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. Today, we wanted to talk a little bit about the strategies that you might want to have if, in fact, we might be seeing a pending recession. We did a video where we talked about whether we think a recession is going to occur, and we have very clearly stated that we're not sure. There's a lot of different indicators that are saying different things, but it's very, very possible that we might be nearing a recession. So what do we do? Experienced investors know that they're not able to predict a recession, and that a diversified portfolio is really most appropriate because it limits risk and it sets the capital aside to invest during a recovery and experience the recovery in the right way. And so we just wanted to talk a little bit about how we have structured our portfolios to weather this storm. And so we see a lot of people that come into our offices with these portfolios that are structured in a way where they're primarily invested in a 60-40 type of strategy. And 60-40 is a very, very old traditional way of looking at investments. It goes back to the 70s in the old brokerage world.
That's right.
And we're surprised that people still think that that's adequate, because the science behind investing has shown, and our experience of how we've been investing our clients over time has shown that that's not really the ideal strategy.
It's just a starting point, and adding other assets that help improve diversification is really the way you fine tune the 60-40. And that's what we've done. We fine tune that allocation to include a lot of other asset classes that dramatically improve efficiency and also reduce the downside in bad markets.
And so what Steve's actually referring to when he's talking about finding these other asset classes, we continue to diversify based upon risk factors. So what we're doing is we're looking at each asset class that we've selected and determining their statistical numbers, their risks, the risks associated with each of those investments, and their relationship with the other investments that we've used. And we often talk to people about one metric that we use, standard deviation. It's a very, very common metric in the statistical world, and it has a lot of assumptions behind it, and it's an easy metric to explain to you. But I want to assure you that we use some much more sophisticated metrics around statistics that incorporate the idea that returns aren't always normally distributed. For those of you who know statistics, they're non-parametric, and they will take into account the relationship of investments in different economic environments, what people often call different regimes. And so it's very, very interesting. Someday we'll get Steve to do a video where he just talks about that. And those of you who want to get a lesson in heavy statistics can learn about it, because it really is fascinating.
And I want to mention something that even there's some types of risks that can't be quantified mathematically. And that's, I call it event risk. And so, for example, there's no way we could have predicted COVID. What happened to Ukraine and what happened with Russian investments in Russia and other places. We talked about that in one of our videos in the past regarding international bonds. You can't quantify that type of thing. Some of that stuff is just stuff you just have to sort of have a feeling for, and because you can't quantify it, you just have to have enough knowledge and enough experience in investing to understand that these types of risks do exist, and they're not incorporated in the numbers, quite honestly. But they can be devastating to a portfolio.
So this actually is not the 60-40. This is actually a client that would come in and they'd say, I don't care about risk. I'm invested in the long run, and I'm fine just investing all of my money in a good ETF, like a SPIDER, SPY. If those of you are familiar with that ETF, I'm just going to put all my money in the US stock market and I'm going to let it ride. And that's what you see on the right-hand side of the slide. And in theory, that's fine. Over the very, very long run, we know that the stock market does always eventually move up. We know that as long as we remain a country and a society and people need goods and services, that in the long run, it will always go up. The question
Always
is,
grow.
yeah, the question really is, what does long run mean? Does long run mean 5 years, 10 years, 20 years, 30 years, 40 years? What does it mean? And I would argue that for most of us that have our little lives, that we need our money, that long run might not always even be within our time frame, that it might even be longer than our time frame. And that's a big concern. What will happen over the next 20 years? Somebody who's 65 and they come to us with a portfolio, or 60 and they come to us with a portfolio and they say, I'm concerned about the next 20 years, which is a good time frame to actually look at what can I expect. And we would tell you that it is very possible that the S&P 500 can have some rocky roads in that period of time. We saw it back in from the period of 65 to
1981.
Yeah, that whole period of time, the market, if you actually just invested in the market and you did nothing and you rode the roller coaster up and you rode the roller coaster down and you just sat tight in your seat, you would not have done too much damage. You would still have the same amount of money at the end of that period. Although when I say the same amount of money, I'm talking about nominal money. I'm not talking about real money, because in that time frame we had inflation. So you have a loss in terms of your actual purchasing power, which is not good. And so we're always trying to consider those things when we work with clients. Is what is your ability to stay invested for long periods of time? I always talk about the roller coaster, and I say, no matter what, when you invest, you are going to be on a roller coaster. The question is, are you going to be on the big roller coaster, or are you going to be on the baby roller coaster? And the big roller coaster, just hang on tight and keep your seat buckled, because you don't want to get off in the middle of the ride. You're going to get hurt. Same thing with the little roller coaster, although there's more opportunity to exit the strategy or do something different or have access to your cash at times where things aren't running so well. And so this portfolio on the left-hand side is one of the portfolios. We actually have a Model 10, Steve, that we didn't include here, but I think Model 9 is fine. We can talk about Model 10 is even.
I just want to add something real quick. There's a big difference between now and what happened from 66 to 81, is that it was very difficult to take sectors of the market, for example, sectors based on valuation, and invest just in those. So for example, we have the ability nowadays to invest more in the value stocks on a very diversified basis in the stock market, whereas they really didn't have that ability to do it on a diversified basis back in that time period, unless you just bought individual stocks. We can take sectors of the market and exclude the most overvalued stocks. And there's probably about, and I looked at it just yesterday, about 20% of the S&P is represented by about 10 stocks. And because we lean toward value, those most overvalued stocks are pretty much not highly represented in our portfolios.
Right. And so that's essentially what we're doing. So for somebody that's just in the SPY, just in the S&P, you're essentially remaining in the stock market as if it was 1965, and you don't have the options that we have today. But the truth is that we do have more options of diversifying you and reducing risk. And so that's what we're looking at doing. And so we have rationale and reasoning for every single choice in this portfolio. This is our recipe, if you will. There's a reason why we have a quarter tablespoon of this, or a cup of that. We've done the analysis behind it, and we can explain to you the parameters that we're looking at. And we have tried to in some of the videos that we've done so far, and we'll continue, because we want you to understand why that investment is part of your portfolio. But when you look at it, even just looking at all the individual colors, you can see that clearly we're diversifying you, and we're not diversifying you for just the sake of diversification, which is something else I like to bring up, Steve, because I've seen people come in with a bunch of different mutual funds or a bunch of different things. And if you do an overlap report and do the analysis of what each of those investments are holding, they're holding the exact same things in different wrappers.
Just with different names according to the funds. Yeah, I just want to bring up one thing real quick. Those blended rates that we show you there, those are historical. I don't want to in any way imply we think that's what the returns on any of this is going to be going forward, just from a compliance standpoint.
Absolutely. They're expected returns based upon histories, a lot of data that we've pressed and compiled of what has happened in the past. And so that's really the best we can do, really, is look at what's occurred in the past and say, well, if in fact we wanted to invest in a different way, would we, how could we do that? And so this portfolio on the left-hand side in Model 9, which is slightly, Model 10, I think, gives us a tiny bit increase in that expected return, but that is the expected return based upon historical data. So good.
And by the way, it's very hard to exceed the return on small cap stock. I would say that's typically the limit in terms of the highest return you can ever expect long term. And that's around 12 to 13%, but there's an enormous amount of volatility associated with just holding small cap. And so that's really the limit in terms of what you expect. So somebody says, I can earn 15, 16%. Don't ever believe them.
Well, if you were smart enough in the beginning of 2000 to put all your money in small cap and just be in small cap for the year, for that 10-year period, you would have done better than large cap.
That's correct.
But most of us don't have that crystal ball and did not know that during that period, which is why we held small cap, but at a portion that we felt was adequate and appropriate for people's portfolio.
And that's why we have this blend here, because we don't know ourselves.
So we do a lot of analysis on this portfolio. One of the things that we do is something called, some people have heard of Monte Carlo analysis, which we've talked a lot about. It really is a great way of doing, looking at probability. We have always looked at the probability of it, when you work in finance, whether you work for a corporation or whether you work for an individual. If a corporation is looking at buying a business or implementing a new procedure or buying a piece of equipment, they always look at what is the best case if everything goes exactly as planned and it's a wonderful world, and what is the worst case if things just don't go right. And that's how good CEOs make decisions in the corporate environment. We believe that that's the right way of making decisions in the private and in your personal finances as well. What is your best case and what is your worst case? And so the Monte Carlo simulation takes the strategies that we're employing on the right-hand side, the S&P 500, and then on the left-hand side, this Model 9 portfolio, and looks at the potential of, what if I invest $1 for 20 years in this strategy? What is the absolute best I can do, and what is the absolute worst I can do? And it uses a bunch of different metrics. One of the top metrics that we've talked about already is that standard deviation metric, the standard deviation of the portfolio, not of the individual investments. By combining these different investments, what is the standard deviation of the portfolio? And if you look 3 lines down on each of those pieces here, we can see that for the S&P 500, the standard deviation for this period of time is somewhere in the neighborhood of 17.5, whereas the standard deviation of this Model 9 is at 14.25. And I can tell Steve's a little uncomfortable because he would love to get into a lot of much more detail on these risk parameters, because there's a lot of detail. But if we could keep it somewhat simple for you, hopefully you can understand what's going on here, because it takes this standard deviation is a measure of how volatile things are and
That's right.
comprise that. And so you can almost see here that the S&P 500, if we take $1 in the beginning of that time period and invest it over time, that there's almost, I guess, visually, these look very, very similar, but nine is a little bit more compressed. And the place where we think it matters most is when we look at the ending values.
That's right.
So the ending values on average are somewhere in the similar ballpark. On average, if we took 1,000 iterations and we compare them in each model, you would wind up, the dollar would grow to almost around $8.84, 86 cents, depending on which model. It's very, it's pretty similar. If all the stars line up and it's, things go, in all the right direction, you would be better off being in the S&P 500 over that 20-year period, because
That's
the
correct.
maximum amount on that is higher than the maximum amount on the Model 9. However, for us, being conservative investors, feeling that we want to be responsible in the way that we invest, we are always looking at that. What is the worst case scenario? And the worst case scenario with an S&P 500 is that it is potential that you could lose money over a 20-year period. And we're not even talking about purchasing power. We're talking about nominal dollars, that it's possible in this iteration and in our probability analysis, there are some instances where you could lose 18 cents on the dollar and actually wind up with 82 cents.
So
whereas
from 2009, I'm sorry, from 1999 to 2009, the S&P actually had a negative return of about -6%. So if over that 10-year period, we saw that happen. And there's certainly a probability that over a 20-year period, you could end up with a negative return on the S&P. But by having these other asset classes in the portfolio, we lower the risk of that happening potentially. And that's the key, because look, what's the purpose of your portfolio? It's really meant to fund your lifestyle in retirement, especially. And so for you to have less dollars after 20 years, and especially as Laura mentioned, that doesn't even count inflation. You could possibly have been withdrawing money from your portfolio. It could be quite devastating to you. So that's why having better balance in a portfolio, being more diversified, is so important. And by the way, we do typically stress test when we run through your financial analysis. We do typically stress test your circumstance using a bear market. For example, we may use a bear market with a decline of -10% over the next 2 years to see how that affects your circumstance.
So in this case, you can see that in Model 9, none of the instances ever had a reduction in the overall balance. That it always, the worst case scenario was that you were going to make 20% in 20 years. Not a good return, because if you factor that in over the 20 years, you're not making that much, but at least you're going to stay whole. And so that to us is what we think our job is to manage your risk while you're investing, and
That's right.
to make sure that you stay in your seat and you stay invested, because that's in the long run how you're going to be successful.
Oh, there we go.
Yeah, this slide shows the 60-40 that we often see. And for a 60-40 model, how would we take a similar type of return projection, again, based upon historical data, targeting a similar type of return, but with less risk. And so on the next slide, it shows you the probability analysis that we do, and the fact that we're looking at dropping your standard deviation from 11.7 down to 7.9. And that in the worst case scenario of a 60-40, it's not too bad, but it's possible that you could lose 3 cents on the dollar. And the worst case scenario on this Model 4, and you can see this better on this slide, that it is tighter than the 60-40. That the worst case is actually that you'd wind up with $1.47. So it's much more controlled around the expected return. It's not so wild. It's not the Wild West as it might be more on the right side of the page. It's more controlled. Again, the average returns are somewhat similar. So the average ending values are somewhat similar. You will actually potentially do better in the 60-40 model.
Right.
In some instances, a matter of fact, if you were in the 60-40 model in the past 5 years, possibly even 10 years, you probably did better than the Model 4 portfolio. However, if you were with us for the past 20 years and you were in our Model 4, you would have done better in the Model 4 because the combined 20 years takes into account a period of time where the S&P just was not performing.
That's right. Yep. And also, by the way, we see rotation over that probably the early part of the last decade. International was actually beating domestic. And so if you didn't have international that period of time, it might have hurt your portfolio. Now, over the last 10 years, it's been the other way around. But who knows? It could rotate to the point where international starts beating domestic again. And because we can't predict these things, we need a piece of everything.
And they're pieces of everything. I mean, we've recently did a video around commodities and how well they returned. I mean, if you were in a 60-40 model this past year and a half versus our Model 4, you did not do as well as our Model 4 again, because we had other things that stepped in and helped replace the returns, like commodities.
And most of our clients have not captured, in fact, I don't think any of them have, as much of the decline we've seen this year in the S&P as because of the diversification. In most cases, about half. The downside capture has been about half or less.
For the more aggressive portfolios, I'm not sure about Model 4. I think Model 4 is even much
Probably even less.
Yeah.
Yeah.
Yeah. So again, that's how we position you for a recession and for whatever is going to occur. We want to make sure that you stay in your seat and that we can make sure that you experience the rebound and that you're going to be okay over the next 10, 20 years. So again, if you have questions with your portfolio, we're always available to talk. Thank you.